What are you doing to get your investments right? So today I'm going to be talking about this rational investing and those three funky symbols there. I'm going to get into them a little bit. So have you ever had a project that you were working on? Maybe it's a house project or something like that, where you thought, well, I'm going to do this. This is going to be something simple. Maybe it's something like hanging a fixture or something like that. It's like, hey, no problem. I can get this done. So I'll do it. And then you go in there and you get it started and you work on it and then you mess it up and then you mess it up again. And then before you know it, it's completely wrong. And then you wind up letting your fingers do the walking. Of course, now it's Google. And you find somebody who can actually get it done because you didn't get it right the first time. And then it actually wound up costing you a lot because you didn't get it right the first time. Now, I had one of those situations that was huge one time. And this is all about you, but I want to tell you a story. It relates to it. So when I bought this house that I'm in right now, and I'm in Castle Pines, Colorado, my wife wanted to make some changes to the house before we moved in. So we hired a contractor. We thought we did our, vetting on it, but we didn't really vet him that well, I guess. So this contractor came in and we had quite a few projects, basement redo and everything else. So to make a long story short, they completely messed it up. They left paint all over the floor. They messed up all the wiring and the plumbing. We wound up having to get engineers out. We wound up having to get other electricians out to analyze it. We tried to sue the guy. It was ridiculous. We had to hire somebody else to actually fix what they did, and it wound up costing 3 times what it should have. That is what I'm trying to help you avoid. And so what I'm going to do is I'm going to talk about how we get this investment thing right. Because, almost everybody wants to be retire ready. Either you're already financially independent or you're trying to attain financial independence. And that requires smart planning. And, we all want to, basically we want to get our finances in order. We all want to, I guess just to be at peace with a comfortable lifestyle all throughout our life, right? Even while we're working, we may never feel like we ever want to stop working because we love what we do, which is kind of how I feel. Or you really want to just stop what you do and you want to kind of have a paycheck replacement, and that paycheck replacement is your portfolio paying you. Maybe you get a little Social Security along with it or a little bit of a pension, but your portfolio is going to be doing the heavy lifting for you. So what I want to talk a little bit about today is how do we get this thing right and what does it take to get it right? And I'm going to talk about a lot of things that should be done. Okay. And I want you to ask yourself, what am I doing? And what have I chosen as an investment program for me? And is my investment programming doing these things? And are these things important to me? So what does it take? The investment solution you select should be based on a disciplined process for managing your portfolio. It should consider a holistic view of your finances, and it should be tailored to your goals. The selected strategy that you take should be very responsive to changing market conditions, as we've seen lately. It should be constantly seeking new opportunities for growth, and it also should be preserving your capital over a long period of time. So when you're choosing how you're going to have your investments managed, it's important that you have an approach that's based on rigorous research and evidence, and that you're working with experienced professionals. It's really important that you're working with people that are proven and experienced. For example, our investment professionals are chartered financial analysts like myself, decades of experience managing money and expertise. So want to make sure that whatever team you're working with are doing is got that experience. Or if it's you who are doing it, that you are really into it and that you have the knowledge and capabilities. So first of all, what does it take? It first starts off with customization. So when you're choosing what strategy is right for you, be sure that it's not cookie cutter or, because a lot of times people are tempted to buy these one size fits all investment programs. Maybe it's a retirement 2025, or maybe it's some robo-advised solution, or it's some mutual fund wrapped program that some insurance agent recommended. I would resist that because what it really takes, you can be led astray by that. And what it really takes is that you want to have a tailored approach that's really tied into your goals. And it starts off by understanding your return and risk profile, your income needs, your time horizon, your tax situation, and a myriad of other factors. But those are the main ones. So if you invest right from the start, that's going to make a huge difference on your wealth. And the other thing that's really big is it's going to give you a lot more comfort over different market cycles, which is really important, because when you abandon a program at the wrong time, that could really hurt you. Anyhow, so let's start off with the foundation of what it takes. It starts off ultimately the mix that you decide in your strategy for stocks, bonds, and alternative investments like real estate, gold, Bitcoin, whatever it may be, and cash. Those are the big areas. That mix that you decide is going to have the biggest impact. It's going to have a great impact on your returns. Your mix represents the backbone of your investment strategy. So it's critical to your success that you get it a right fit for you on that. So your strategy has got to be customized, targeted for giving you a competitive expected rate of return, and the risk should be acceptable personally to you. So that's why we don't really want to, that's one of the reasons why you don't want to have a cookie cutter approach. So you want to start off with a long-term strategic mix. So basically what you're saying is, I want a mix of investments as a starting point that I'm going to consider that has the long-term expectations of returns and risk, and even correlation, how the investments move together, because that's related to risk. It's important that your strategy is forward-looking. So in other words, you're not just using historical data to come up with a mix. You're actually looking at an educated analysis of the forward-looking expected returns and risk. So that in your strategy, that should be being done in your strategy. Now, the other thing that a strategy should do, it should seek opportunities. So you don't want some static portfolio. And a lot of people kind of are proponents of that. And we're not proponents of that for many different reasons, which goes beyond the scope of this call and this video. But your strategy should seek opportunity. It should also take advantage and be adjusting for above average opportunities available in the marketplace. So at any given moment in time, there's going to be something out there that has a better outlook right now. Maybe it's beaten down unduly and there's going to be a recovery and things are doing well there. Or maybe there's some new products and new services in high demand and there's opportunities there. So an assessment of the current economy, the current capital markets, that should be used to also be looking at above average opportunities. And this kind of creates what's called a tactical asset allocation. In other words, what am I going to overweight or underweight in my investment portfolio based on their attractiveness? So a good rule of thumb is to try to keep your tactical overweight or underweight to, no more than 20% of your strategic mix, that long-term mix. It could be more, depending if you want to be more active. But a good rule of thumb to start off with is to have a defined range of no more than 20%. And that's typically at the major asset class, stock, bond, alternative, cash. So once you've got so we've talked about strategic asset allocation, tactical asset allocation, which is important. But now we're getting to where the rubber meets the road, the investment selection. So once you've got your target allocation that's customized, established for you, right? Whatever investment you put in there must meet stringent criteria. And this requires due diligence and requires attention to detail. So individual equity securities, i.e. stocks, there's three main dimensions you want to look at for stocks. And we can get into big detail on this, but at a high level, you want to look at the quality and the valuation and the technical factors of stocks and screen them over a large database of publicly traded stocks so that you can find the most attractive investments and diversify those across sectors, industries, and styles. So that's a real big, important success criteria. And that will give you more robustness in your portfolio, meaning that your portfolio can stand ups and downs in the economy. Okay, so now if you have any funds or ETFs in your portfolio, it's important that you have due diligence in selecting them too. So best of class solutions there. And that requires a rigorous analysis of the expenses, the taxes, and the returns over time. And also, you've got to consider who the people are that are behind it, what kind of processes that organization has, what is their operational stability, and any liquidity requirements that you may have. How tradable are they, getting in and out of them for your flexibility before you even put those in your portfolio. It's like building a recipe and putting them together. So you want to look at each one of those individual opportunities, return and risk expectations, and correlation for each one of those. And that's what these three things are: return, risk, and correlation. And we call them different things here internally, but that's a kind of an easy way to think about it. So now the last part that should be done in order to have a retire-ready portfolio, a robust portfolio, what are you doing to monitor and make adjustments? So the decision to buy or sell or rebalance the portfolio, that should be done based on the opportunity and the risk assessment. So that whatever strategy you have should be looking at what investments are more or less attractive over time, and your capital should be adjusted accordingly, and overweighting those that are more attractive and underweighting those that are less attractive. So the investment solution you choose should make an effort really to systematically review those holdings based on the concepts that we're talking about here. And finally, the investment solution should be regularly reviewing performance and evaluating that compared to a representative benchmark, a broad representative index. And that should really be tied to be representative to what your tailored strategy is. And that'll help you reap the benefit of consistency in your experience with your investments. So that's what it's going to take. It takes basically seeking opportunity. You start off with a foundation. You have a tactical opportunity seeking element, and you have due diligence with the individual investments being selected, and a process to be dynamic and to monitor and to make adjustments for whatever's going on in the economy right now. So that's all I have for you today. If anybody wants a second opinion on your portfolio based on these factors, just let us know. We actually, like I've been saying, I've been making a point to make myself available to talk to people because there's a lot of craziness going on in the world. People have a lot of questions. So I set up a website. It's a real simple link. It's called talktoluisllanes.com. talktoluisllanes.com, and you can get a hold of me and have a free conversation with me for 15 to 30 minutes. So I hope that you are doing well, and I am going to sign off for now. Have a great day, you guys. And oh, by the way, if you're getting a little bit down about all this stuff around you, one of the best things that I've found is if you have kids, spend more time with your kids. And if you don't, get out and exercise. All right. Have a good day.